Welcome to Teach You Academy. This is for educational purpose only. And our topic today will be how to determine your debt to income ratio. Step 1, list your monthly debt payments. Include mortgage, rent, auto loans, student loans, personal loans, minimum credit card payments, alimony, child support. Exclude utilities, groceries, insurance, discretionary spending. You can exclude those. So step 2, you're going to calculate gross monthly income. Use pre-tax income, annual salary. Divide that into 12. Your hourly rate times your hours, which is your week times. So basically, hourly rate times hours times the week times 52. Divide that into 12. Bi-weekly check, paycheck times 26. Divide that into 12. Self-employed, average net income over 12 to 24 months. Step 3, add up your monthly debt. Sum up all monthly debt payments from from step 1. Now what you're going to do, divide the debts by income. Debt to income equals total monthly debt. Divide that into your gross monthly income times 100. Here's an example. Say hypothetically you're making $72,000 a year, which is $6,000 a month. So your debt comes out to be, your rent is 1,800 plus your auto payment is 350, and your student loan is 220. Your credit card is 500. So that's a total of 2,420. So your debt to income, you're going to take that total right there and divide that into 6,000, which is your total month income that you're bringing in. and that's your debt to income ratio, 4.3%. I mean 40.3%. So that's how you calculate your debt to income ratio. So a good debt to income ratio is below 36%. Mortgage approval below 43%. Some up to 50%. Now here's a pro tip: front end ratio. Housing, divide that into your income. Say hypothetically your housing is 1,800 a month. Divide that into 6,000, which is your monthly income, and now that's 30%. That's basically saying that if the only expense you have is a housing expense, and you're making that kind of money, you at 30%. So you're well below the what they're looking for. Now here's the summary. We listed your monthly debt payments, calculated gross monthly income, and we added up your monthly debt. Divide debts by income, and we also talked about your targeted debt to income ratio. Thank you for watching Teach You Academy, and this was just educational information only.